The Federal Reserve is making a prediction. By the time we reach October, Americans are expected to have drained their savings. This doesn't imply an immediate collapse of the U.S. economy, but it does mean that the day-to-day lives of ordinary Americans will become more challenging. So before delving into the statistics and details, let me provide you with a broad overview of the current situation. Presently, everyday Americans are grappling with the difficulty of managing their expenses. If you've ever felt like you're constantly struggling to make ends meet as if you're stuck in an onion cycle of financial stress, then what I'm about to show you will shed light on why you've been experiencing these hardships. Let's start with examining the housing market, which has witnessed an alarming surge in prices over the past few years. The chart I'm about to show you illustrates the staggering increase in rent since 2020. On average, rent has surged by 18%, and in some regions, it has skyrocketed well beyond that figure. Shifting our focus to the housing market itself, home prices have reached historic highs. Currently, the average 30-year fixed mortgage interest rate stands at a daunting 7.5%, contributing to a situation where home affordability is at an all-time low. Now let's shift our attention to the automotive sector. The prices of used vehicles have experienced a jaw-dropping 44% surge since 2020. Isn't that simply astounding? I've conducted a thorough analysis of both the new and used car markets, all in an effort to assist people in securing the best possible prices. So please stay tuned for my upcoming updates, as I strive to provide valuable insights to help you navigate these challenging economic times. Let's shift our focus to gasoline pricing, which have seen a 39% increase since 2020. Although they have come down from their peak, gasoline prices are steadily climbing once again. As of this September, gasoline prices have risen year over year. Now, let's talk about cereal and grain prices, including your everyday bread products at the grocery store. Since 2020, they have surged by 29%. To put this in perspective, before the pandemic, you could fill a shopping cart with groceries for $100. But now that same cart costs $150 or even more. It's abundantly clear that these fundamental expenses for housing, vehicles, gasoline, and food have all surged by 20, 30, or even 40%. However, wages have not experienced a similar increase since 2020. Ordinary Americans are bridging this gap by relying on their credit cards or dipping into their savings. And as you may well know, this is an unsustainable and incredibly stressful situation. Now, I've seen numerous comments requesting solutions, and I want to assure you that I am committed to delivering solutions. My entire channel and mission are dedicated to financial education. I will provide practical, realistic, and actionable advice to help you move in the right direction. We'll start with small, manageable steps, addressing both how to increase your income and save more money. In this video, my primary aim is to acknowledge the struggles that everyday Americans are facing and to explain why. It's crucial to grasp the situation before you can work on improving it. I'd like to draw your attention to a critical issue. Inflation has spiraled out of control, primarily due to the excessive money printing by the Federal Reserve. While there are other contributing factors, this was the primary driver. Now, let's delve into the details. Inflation was exacerbated by corporate greed, with businesses aggressively passing on their rising costs to consumers. From a consumer's perspective, many did not resist these price hikes, resulting in continued purchases and soaring corporate profits. However, the landscape has changed significantly. Americans find themselves more financially strapped than ever, and corporations have come to realize that they can no longer raise prices without encountering resistance. Consequently, U.S. consumers have become more discerning, actively seeking alternatives or substitutes when prices become prohibitive. It's essential to connect all these dots. And to emphasize this, I'm going to share a statement from the Federal Reserve Bank of San Francisco. Please note that this statement is not my opinion, but rather a fact coming from a reputable source. The U.S. nearest Federal Reserve has consistently claimed that Americans have been flush with cash due to their pandemic savings. This message has been reiterated throughout 2023, and if you've been following the Federal Reserve closely, as many have, you'll know that I'm not exaggerating in the slightest. However, the latest stance from the Federal Reserve is that Americans are now depleting their savings and running low on funds. Let's take a closer look at the data, and please keep in mind that this information is based on their collected data. They're indicating that household savings have been on a steady decline for the past 23 months. Here are the figures. According to the Federal Reserve, Americans had saved a substantial $2.1 trillion by 2021. However, as of July, this savings has dwindled to a mere $190 billion, with a rapid decrease of $100 billion per month. In the words of the Federal Reserve Bank of San Francisco, they have stated, U.S. households are on track to deplete their excess savings accumulated since the pandemic as early as the end of September. It's important to note that the Federal Reserve operates independently from the government, and even when we examine government figures, the message remains equally concerning. Government data reveals that the personal savings rate dropped to 3.5% in July, down from 4.3% in June, which was already down from 4.7% in May. Here are the last 3 months. We've witnessed a sharp decline from 4.7% to 4.3% and finally down to 3.5%. To put this in perspective, the savings rate stood at an average of 8.8% in 2019, pre-pandemic, and now it has fallen to a mere 3.5%. Adding to these financial challenges, student loan payments are set to restart in October. With 43 million Americans carrying student loans, the average monthly payment is expected to range between $300 to $400. This impending reality will have a devastating impact on millions of Americans already grappling with their finances. Let's consider a fundamental fact. The United States of America relies heavily on consumer spending to drive its economy. When the U.S. consumer is facing financial challenges, it leads to more businesses going bankrupt. As I mentioned back in 2022, this prediction is now becoming a reality. I had previously mentioned that bankruptcies would surge in 2023 due to higher interest rates, and this prediction is coming to fruition. In fact, Bloomberg reports a significant increase in business bankruptcies in August, attributing it to the rising interest rates. What's even more concerning is that bankruptcies have been on the rise for 13 consecutive months, painting a worrisome picture of the economic landscape. Last week alone, 6 large businesses filed for bankruptcy, each of them having assets worth at least $50 million. However, it's essential to understand that the current business environment is particularly challenging for small businesses. Small businesses face difficulty accessing affordable capital, which means we can expect to see more small businesses succumbing to bankruptcy. This isn't to say that larger corporations are immune. It simply means that we're likely to witness a higher proportion of bankruptcies among small businesses compared to larger corporations. In my previous videos, discussing the Federal Reserve and interest rate, I've outlined my belief that the economic situation will deteriorate primarily due to the impact of a high interest rate environment. It's a straightforward argument. However, major banks, financial institutions, and even the Federal Reserve hold a different view. They assert that the economy is currently thriving, with the Federal Reserve of Atlanta forecasting a robust GDP growth rate of 5.6% in the third quarter, spanning from July to September. So, if you're anticipating a recession, these big institutions are suggesting it's a thing of the past. Goldman Sachs, for example, has put the probability of the U.S. falling into a recession within the next 12 months at just 15%. And Bank of America predicts a soft landing as the most likely scenario. However, not everyone shares this optimism. In a recent survey conducted by Kenny Piak, a striking 71% of Americans expressed that they perceive U.S. economy as either not good or in poor shape. This presents a significant disconnect between public sentiment and what the big institutions are proclaiming. It doesn't sound like a booming economy or one with a GDP growth rate of 5.6%. Time will tell how this situation unfolds. Here's summary. Today's video serves as a high-level overview of the current economic landscape. Mark your calendars for important dates. September 13th, when the inflation report will be released, and September 20th, when the Federal Reserve will make its decision on whether to raise interest rates further or not. Stay tuned and please subscribe for ongoing updates on these developments. Thanks for watching. Until next time.